So when we talk about risk-reward ratios, I'm generally thinking the rule of thumb is 1 to 2. So risk 1,000 to make 2,000, or risk 100 to make 200. Translate that into trading terms. You're trying to make 60 ticks, then you want to put your stop loss 20, 30 pips on your entry price. Okay, that makes sense. For me, I don't trade every day. I don't trade all the time. So my risk-reward ratio changes. Okay, I'm happy to risk anywhere between 10 and 25% of my account value on any one trade. And that's because, again, I don't put it all at one price. I put smaller increments of size in at different prices. That means that I'm taking the same kind of overall risk, but I'm spreading it over prices. So when it goes in my favor, I can hold trades longer and I can make more money. Okay, so it isn't as black and white of just saying that if you only ever risk 1% of your capital, then you're only going to lose X amount of money and you're going to stay in the game longer. That is true. But if you've waited for trades, you're not going to make as much money on the profitable trades, are you? So again, it's that balancing act. Maybe trade 3% of your capital on big figures, but only with a finite range, a tight range of that figure. If non-farm payroll is expected at 100,000, don't buy it unless it's above 130. Don't sell it if it's below 70. Don't trade it if it comes out 101. Okay, and that by doing this and setting things out the right way, you can use more of your capital on the good opportunities. But again, if you don't have a plan and you don't have any kind of cash and risk management, then you're kind of frightened into trading 1% of your capital because you don't know anything else. You don't know any other way to trade. You don't know what's a good opportunity, what's a bad opportunity, apart from the money it made you. So for me, by looking at things as I do, with my trading, getting involved in the extremes of the market, I've had a gold's gone down 250 points in 3 red hourly candles. I know it has to retrace, so I'm happy to trade and buy, even though the market's going down, smaller and smaller amounts, into that bottom of the market to let it retrace. And I know the odds are in my favor that it has to retrace at some point. I'm going to make some money. So maybe I, average in 2% of my account. It goes a little bit further down, 4%, further down, 8%. I can get all the way up to 25%. But by the time I'm buying more and bigger size towards the bottom of the market, as it comes back, I've got the opportunity to scratch. Or as it bounces back up, make some profit. Okay? But again, that's just my style. I understand my risk reward. I understand what I use my capital for. And so do you. If you don't understand it, then you're not going to be able to do these things. So as I said, the key for me in these current market conditions, especially when entering the market, is to start small. Start with a one lot. Start with, a pound, whatever the minimum stake is. You can always put more in. Okay? Generally when you're offside and you're taking money out, it'll either be for a profit or a loss. But as you do that, your size becomes smaller. The benefit of starting small is you can always go higher. You can always use more margin. It doesn't work the other way. So for me, the volatility is good because it allows me to make, more money more quickly because of the market retracements and the market extensions. And again, with being able to average and being able to use my own cash and risk management in that way, then I don't actually have to use stocks. But again, as I've shown you, there's different ways of trading. So as I said, why beginners lose money, again, I've kind of gone over this really. It's really because, they don't have a plan in place. So they'd rather see a position go 100 ticks offside and take a 20-tick profit or even a scratch. So as I said, we've all been guilty of this. We've all done this in our trading careers, but it's not sustainable. You can't let trades go wildly against you. So that's where your risk management has to come into play. You have to know when to stop, when it's wrong. So why use stops? Well, again, as I said, if you're talking about the basics of cash management, then it's to protect your capital, okay? They're not always rational. They can over-exaggerate. So as long as you've got a fixed stop in place you can afford, you know how much money you're going to lose in a trade. And that could be the only way some people can trade. But as I said, as I pointed out, it's not the only way. So if you know how much you're going to lose before you put the trade on, well, really, you're right. If you can afford that loss, then you've never really gone out of your risk-reward parameters, okay? So again, when the market goes against you and you get stopped out, that doesn't matter. You can always get back into a trade. There's always more than one opportunity to make money out of any move. And then stops allow you to take a step back. And if you are on side, okay, you can walk away from your screen. Or you can take take a bit of a deep breath. Once that stops in place, you risk, you're out. And all you've got to focus on then is the upside, where to exit. So as I said, avoid excuses. Okay, I got stopped out. The market went exactly where I was going as when I got stopped out. Again, from trader talk, from being a risk manager, that translates into my entry level was wrong and I misjudged where the market might go first. We've all done that. Or placed a position that was too big for me, or too big for me to handle. I got frightened of being offside amount of money, so I got out. Okay? That's the two reasons why people lose money in trading, as I said at the start of the presentation. So the art of trading is judging where the market might go beforehand, before it hits your target. So you've got to adjust your size accordingly. So for me, it's all about using the right kind of size at the right kind of time. So how to conserve money in volatile markets? Well, that's what we're in. Okay, keep to your rules. Pick a time of day to trade. Don't trade the opens, I would say. Okay, use stops if you want to. Negative, positive, average, manage your size. These are the 5 things we need to look at. Okay, so have your trading rules in front of you. Simple as they should be written down. Make sure it takes into account what you've got on capital, because that will dictate your trade size and frequency. And understand the market conditions and how they can change. If you're trading a market that's highly volatile, you have to understand where it can go to. Time of day, if you're trading UK markets, again, understand that it's going to slow down in the afternoon until the US market's open. You know, these are basics we have to understand. When we understand how volatile a market can be, how volatile our position can be, you know, they'll affect our cash, our balance. You have to understand these rules. You know, again, are you a morning or afternoon person? What time of, periods are you trading? These things can affect your attitude to risk. Use stops. Again, if you want to, if you're trying to make 100 ticks, then, to make 15 ticks, you've got to risk 5. To make 100 ticks, you've got to risk 30. Keep it realistic. You're not going to be able to make 100 ticks, consistently with a 5-tick stop. Okay? You're just not going to. Yeah? If you're looking for the smaller moves, the scalping moves, have a small, stop in place. Looking for the bigger moves, again, start with smaller size, build into positions, or give yourself a wider stop. Okay? You're never going to get the perfect entry point. And again, you might make 100 ticks out of a trade, but if you've had a 30-tick stop, and you've lost that, then you make 100 ticks. Then in reality, if you've lost 3 trades in a row, you've only made 10 ticks. So keep it balanced, keep it in the sphere of what you're trying to achieve. Again, common term, I always get stopped out of trade, and that's your entry point. Okay, your stop's too close, or you're trading too big a size. And as I've said, the way to stop getting stopped out all the time is to trade smaller size, and then use wider stops or no stops, and then average. Okay? Averaging for me is the way you trade volatile markets at the minute. So negative average, when the trade goes against you, you buy more at a higher price, you sell more at a lower price. Positive average, that's when your trade's on side. So if you buy in the market, you buy more as the market goes up, or you're selling it, you sell more as the market goes down. Simple as. Okay, manage size. Okay, know when to use the right kind of size. Simple as that. I mean, it's smaller positions allow you to go bigger positions. You can run smaller positions longer. Okay? All these things are psychological as well. If you trade smaller size, you'd be amazed how many people can let a 1-lot trade go 50 ticks and not bother. How many people can let a 50-lot go 50 ticks? Not many. Okay? So use the size that's appropriate to you and for your right style of trading, and also for what you're trying to achieve. Okay? If you're trying to make big money, you've got to put on bigger size. If you're just trying to make consistent good money, your size doesn't really matter. You can still make enough ticks in the markets these days with relatively small size, and again, compound them smaller wins in order to, again, build up your account. So conclusion really is risk management is the art of balancing profit expectations versus your manageable losses. Don't always concentrate on the negative with risk management. It is to do with your stop, but it's also for your exit point. You don't expect to get the market right all the time. Simply won't happen. Remember, the market's not against you. It doesn't care, doesn't know you exist. So don't ever take it personally. When you do take a loss, you press the button to get out. Try and keep it as small as you can. Okay? It sounds obvious, sounds easy. I know it's not. But try and keep it as small as you can. Try and let your profits run and try and cut your losses as quickly as you can. You generally get that feeling that you're wrong. Okay? If a trade goes onside then goes offside, back to scratch, offside. The more it does that, the more likely you are to be wrong. So make sure you cut that as quick as you can and then reaffirm your opinions, reaffirm your kind of trading strategy. You're generally looking to make 7 out of 10 winning trades. Okay, but the 3 losing trades sounds obvious, but again, you've got to reiterate it. Your 3 losing trades can't be the same size as your 7 winning trades. Okay, it's all about surviving. It's all about longevity of trading. So there's no point in making £1,000 in your winning trade than having 3 losing trades of £300. Okay, because with costs and with time involved, you're just never going to make any money.